What if I told you, right now, that the difference between retiring with over $1 million in assets and retiring with nothing isn't your salary? It's not your job title. It's not a lucky stock pick. It's a single habit, one you can start today, with less money than you probably spent on lunch this week. I'm going to show you exactly how to build a dividend snowball that pays you $2,000 every single month, and I'm going to show you the math so you can verify it yourself. Stay until the end, because in the last 2 minutes, I'll show you one small tweak that can push that number even higher, without any extra risk. Here's the reality most people are living. They work hard. They save a little bit here and there. Maybe they toss some money into a 401k they barely understand. And then one day, they wake up at 65 and realize, the math just doesn't work. Social Security is not going to cut it. A savings account earning 0.5%? That's practically burning your money slowly. And here's what makes it worse. Inflation is quietly erasing whatever purchasing power you do have saved. Every year you wait, every year you leave money sitting idle, you're falling further behind without doing a single thing wrong. That's the part nobody talks about. Doing nothing is actually a decision, and it's costing you. So what's the answer? What do wealthy people do differently? They don't just save money. They put their money to work so it earns more money, even while they sleep. That's exactly what dividends are. They're your portfolio working a shift on your behalf. Every quarter, every month, companies pay you just for owning shares in them. And here's the part most people overlook. When you reinvest those dividends instead of spending them, something extraordinary happens. Something called the snowball effect. A small snowball at the top of a hill. You give it a push. It starts rolling. It picks up more snow. It gets heavier, faster, bigger. And by the time it reaches the bottom of that hill, it's enormous. That's your money. That's your portfolio. And today, we're starting that snowball rolling. DRIP stands for Dividend Reinvestment Plan, and the name tells you exactly what it does. Instead of receiving your dividends as cash and letting them sit in your account doing nothing, DRIP automatically uses those dividends to buy more shares. More shares generate more dividends. Those dividends buy even more shares. It's a cycle, and over time, that cycle creates exponential, not linear, growth. Let me show you with real numbers so this clicks completely. Say you own 100 shares of a company priced at $50 each. The stock pays a $2 dividend per share per year. At the end of year 1, you have $200 in dividends. With DRIP, that buys you 4 more shares. Year 2, you don't have 100 shares anymore. You have 104, so now you earn $208 in dividends. Year 3, 108 shares. Year 4, 112. Every single year, the base gets bigger, the dividends get bigger, the reinvestment gets bigger. That's compound interest. And it's the closest thing to a cheat code that exists in legal investing. Here's another reason DRIP investors sleep well at night, even when markets are crashing. Because you're investing the same fixed amount consistently, whether the market is up or down, you automatically buy more shares when prices are low and fewer shares when prices are high. When the market drops and everyone else panics and sells, you're actually buying at a discount. You're loading up on more shares at sale prices. When the market recovers, those discounted shares explode in value. You're not trying to time the market. You're outsmarting the market by not trying to time it at all. And one more thing about DRIP that people underestimate, the convenience factor. Once it's set up with your broker, it runs on autopilot. You don't have to log in every quarter and manually reinvest. You don't have to make any decisions. It just happens. That automation removes the single biggest threat to any long-term investment strategy, which is you. No offense. But the biggest enemy of wealth building isn't a bad market. It's a person who gets emotional and starts making decisions they shouldn't. DRIP takes that temptation completely off the table. I want to pause here and show you something that blew my mind the first time I saw it. If you invest just $40 a week, that's less than $6 a day, into a well-structured dividend portfolio, and you reinvest every single dividend every single quarter. In 25 years, your portfolio can exceed $500,000, and it pays you over $2,000 a month, every month, without selling a single share. That's not a YouTube fantasy. That's compound math. And I'll prove it to you right now. Here's where most beginners make their first mistake. They see a stock with an 8 or 10% yield and they think, jackpot. But a high yield with no growth, no stability, and no track record is a trap. High yields can actually be a warning sign. Sometimes a company's yield looks high because the stock price has dropped significantly, which could mean the business is struggling. Other times, a company is paying out more in dividends than it's actually earning, which is not sustainable. That dividend gets cut, the stock tanks, and you're left holding the bag. So yield alone means nothing. Context is everything. You need 4 types of stocks in your portfolio. Think of them as 4 legs on a table. Remove one, and the whole thing wobbles. The first leg is blue chip dividend stocks. These are the bedrock. Companies like Coca-Cola, Procter & Gamble, Johnson & Johnson. They've been around for decades. They've survived recessions, wars, global pandemics. They pay consistent dividends and they're not going anywhere. Blue chips give your portfolio stability. They're not exciting. They're not supposed to be. They're the foundation everything else is built on. The second leg is Dividend Aristocrats. A Dividend Aristocrat is a company that has increased its dividend every year for at least 25 consecutive years. Think about that. Through the 2008 financial crisis, through COVID, through every market downturn in a quarter century, these companies raised their dividend. That's not luck. That's financial discipline. And it's exactly the kind of reliability you want in a long-term portfolio. The third leg is high-yield dividend stocks. Now we're adding some fuel to the engine. High-yield stocks offer bigger dividend payouts, often 4, 5, 6% or more. Yes, they carry more risk than blue chips, but that's why they're just one leg of the table, not the whole strategy. Used correctly, they accelerate your income growth, getting you to that $2,000 monthly target faster. The fourth leg is growth-oriented dividend stocks. Think Microsoft, Apple, Visa. These are companies that grow their share price and keep raising dividends year after year. They may not have the highest yield today, but in 10 years, their dividends might be 3 or 4 times what they are now. They're building the future value of your portfolio. And here's the rule I use. Only buy stocks that check at least 3 of these 4 boxes. 3 out of 4 keeps your standards high without being impossible to meet. Let me walk you through what a balanced dividend snowball portfolio could look like in practice. These 5 picks hit the criteria we just covered, and together they create a diversified, resilient income machine. First, NextEra Energy, a clean energy giant with a 2.76% dividend yield, nearly 11% dividend growth rate, and strong long-term appreciation. Energy demand isn't going anywhere. Second, Starbucks. Yes, the coffee chain. It has a 3% yield with dividend growth exceeding 16% annually. It's a consumer brand with pricing power and a global footprint. Third, Abbott Laboratories. Healthcare is recession-proof. Abbott delivers a 2.1% yield with consistent 11% dividend growth and solid share price appreciation. Fourth, Home Depot. People always need to fix, build, and improve their homes. Home Depot has a 2.59% yield and a stunning 17.9% annual dividend growth rate. Fifth, ProShares S&P 500 Dividend Aristocrats ETF. This is your safety net and diversifier in one. A 2% yield with over 20% dividend growth, and it gives you exposure to dozens of aristocrats automatically. When you combine these 5, your blended portfolio sits at roughly a 2.5% current yield, a 15.5% dividend growth rate, and nearly 11% annual share price appreciation. This isn't just a collection of stocks, it's a system designed to pay you today, grow those payments every year, and appreciate in value over time. Now, I want to address something I know some of you are thinking right now. 5 stocks, isn't that too concentrated? Shouldn't I be more diversified? And that's a fair question, but here's the thing. You're not just holding 5 companies. The ETF alone gives you exposure to dozens of dividend aristocrats across multiple industries. Combined with the other 4 picks spanning energy, consumer goods, healthcare, and retail, you actually have pretty broad coverage. And as your portfolio grows over the years, there's nothing stopping you from adding more positions. But when you're starting out, 5 focused, high-quality picks beats owning 30 random stocks you don't understand every single time. Let's run the numbers. You're investing $40 a week. That's roughly $170 a month, or about $2,000 a year. Year 1, your portfolio reaches approximately $2,100. Not impressive on its own, but the snowball has started rolling. Year 5, you're sitting at around $14,000. You've contributed $10,000, but compound growth has already added meaningfully on top. Year 10, your portfolio crosses $34,000. Dividend reinvestment is starting to do serious work. Year 15, you're approaching $80,000. The dividends alone are reinvesting over $1,000 a year. Year 20, You've crossed $172,000. This is where most people start genuinely believing the strategy works. Year 25. Your portfolio is worth approximately $385,000, and it's generating over $800 a month in dividends, still reinvesting. Year 28 to 30. The snowball crosses $500,000, and the monthly income crosses that $2,000 target. The total money you personally invested over 30 years? Around $62,000. The portfolio it created? Potentially close to $1 million. The rest is compound growth doing the work you set up decades ago. Here's something I want you to really sit with. Most people spend 30 years going to a job, trading time for money. This strategy flips that equation. You spend 30 years letting money trade for more money, and at the end of those 30 years, the job ends. But the dividends? They don't. They just keep coming, month after month. Whether you're traveling, whether you're spending time with family, whether you never want to think about money again, the portfolio doesn't clock out. Remember at the start, I promised you one small tweak that can supercharge this whole thing? Here it is. Increase your weekly contribution by just $20 more. Go from $40 to $60 a week. That's one fewer dinner out per week. That's canceling one subscription you forgot you had. That's truly a rounding error in most monthly budgets. But here's what that extra $20 does over 30 years. At $60 a week instead of $40, your 30-year portfolio can reach $1.5 million, paying you over $5,900 per month in dividends, from $20 a week extra. That's the power of compound math applied consistently over time. And here's the beautiful part. Your principal is still intact. You're not selling shares. You're living off dividends while the underlying portfolio continues to grow. So even if you never touch the principal, you can pass it on. This becomes generational wealth. The dividend snowball you build doesn't have to stop with you, your kids, your grandkids. They inherit a machine that was already built and already running. That's something most people never even think about when they start this journey. They're thinking about their own retirement. But what you're actually building, if you do this right, is something that outlasts you entirely. I want to be honest with you. This strategy isn't complicated. There's no special insider knowledge here, no secret algorithm, no exclusive access to deals regular investors can't get. The real secret, the one wealthy investors don't broadcast, is simply this. They started, and they didn't stop. They didn't sell when markets dropped. They didn't pull out when things looked scary. They kept contributing. They kept reinvesting. They let time and math do the work. And I'll be real with you about the hard part too. There will be a year, probably more than one, where your portfolio drops. Maybe it drops 20%, maybe 30%. You'll watch your balance shrink and every instinct in your body will tell you to pull out, to stop contributing, to wait until things stabilize. Don't. That moment is exactly when the strategy is working hardest for you. Your $40 or $60 a week is buying shares at the steepest discounts they'll ever be at. When the market comes back, and historically, it always has, those shares you bought at the bottom will be the ones that carry your portfolio to new highs. The investors who build real wealth aren't smarter than everyone else. They're just more patient, and they understand that volatility isn't the enemy, it's actually the engine. You can do this. The only question is, will you start today? Open a brokerage account this week. Set up an automatic $40 a week contribution. Select your dividend stocks using the 4 pillars we covered. Turn on drip, and then, this is the hardest part, don't touch it. In 1 year, you'll have barely begun. In 10 years, you'll be surprised. In 20 years, you'll be seriously impressed. In 30 years, you'll be thanking yourself every single month. If you found this valuable, hit subscribe and drop a comment below. Tell me, what's your starting amount going to be? $40 a week? 60? Even 20? I want to know. See you in the next one.